So the structure of the investment, because you have to bring now institutional investors, so this is just the highlight of how the investment looked like. As I've said, we had the issuer, we call it Linzi Finco Trust, and we did a 15-year repayment date, or rather 15-year tenor for this particular issuance. We raised around 23 million US dollars at that particular rate. This was in 2024. And the description, or rather the name of the issue, was Linzi Sukuk, or an Islamic secured residential lease-based instrument. So why did we go for a Sukuk instead of a conventional issuance? As I've said, we had to think outside the box and be innovative about our solutions. When we were going to market, the rates were very high. We were talking about, government was, the TBs was around 14 to 16%. And no investor was willing to take anything less than that. But we discovered there's a segment, a portion of the institutional investing community that were not well diversified, or they didn't have enough asset classes that they can invest. And that was the Sharia compliant funds in Kenya. So when we presented a Sukuk-based structure, one, it was favorable because under a Sharia compliant instrument, you are able to give a moratorium on the principal and profit. And for this case, we did a 2-year principal and profit moratorium, so that now we can enable the cash flow from government to go into the project and blend with the cash flow from the private sector, that is the debt issued through the bond, the Sukuk, and the equity that came in from the contractor. So we got a rating of A+ from GCR Moody's, and the return on investment, or rather the IRR that we declared, or rather we gave to the investors, 11.13 at a time when interest rates were very high. Surprisingly enough, we actually got conventional investors to come and bite into this particular instrument. Why? Is because the cash flow streams from this particular investment is guaranteed and sure for the next 15 years. So it provided a very clear, foreseeable path for the investors in terms of their repayment, and they saw stability. It was a good diversification tool because in as much as the government papers was paying very high, they did not have control over that. Right now, it has dropped from the 15%, you're talking about 7%. Now you can see that those differentials also, or the spreads, is not experienced in this particular instrument. And when the rates started dropping, it is one of the investment tools that was stable, even in terms of their net asset value, because the cash flows are guaranteed, and the structure or the enhancement that have been provided for this particular instrument is very good. And the ones that have come on board, they have not regretted. I think it is one of the best decisions that they were able to make. So the communication that, or rather the lessons that we learn from that, is that investors are also looking for stable return in as much as that they are looking for high return. And that is where now our core mandate is to provide, one, is there an impact that your investment is giving, whether social or financial? And two, are you providing a stable return over a period of time? And three, is the investment well structured and well enhanced? Is it being ring-fenced to make sure that during that particular period of time that the investment will stand? So that is how the investment was structured. And just to show you what I was talking about, I didn't want to show this slide because I wanted you to listen to me. And this is exactly what we are saying, is that before 2023, 2024, most of our institutional investors, the pension schemes, were focusing on government papers. And when the rates started skyrocketing, you could see that most of their portfolios started dropping. And some of them were even actually getting negative real return, because also inflation was quite high. But now for the ones that took a bite on our side, unfortunately I cannot show you their portfolio, but I can just say that they were able to be, or rather they were shielded from this kind of volatility. And we can see that what we did in 2024, and we've replicated it again in 2025 with the issuance of the Linzi 003 infrastructure asset-backed securities towards the construction of the Talanta Stadium, is that investors are now finding comfort in diversifying. We can see a move towards equities and a move towards alternative investment. So that brings me to the end of my presentation, but the overarching message is that we have institutional investors, we have investors who are willing and they are ready to partake into impact projects. It's just that how you bring in the structure of the investment, the stability of your investment is what will really matter. So thank you so much, Seeta. I hope I didn't rush. I was told I have 360 minutes to do my presentation. I don't know how many I used of that one. Thank you so much.
Thank you, Victor. We'll save the questions till the end because I think we have a really interesting presentation as well. And how can we bring similar, blended finance to scale up the next presenter? So if we can have Mr. Mukaru online, please. And if you could please just start with introducing yourself as we get the presentation online. And I guess the best way will be that I can move the clicker for you.
That would be great.
You can go ahead. Thank you.
Thank you very much. My name is David Mukaru. I'm CEO of Caritas Microfinance Bank. Let me start by apologizing for not being there physically. Unfortunately, I had a board meeting in the morning, early in the morning. I thought I'll be done and get out. But as you are all aware, around Parliament is a no-go zone. So I'm done with the board meeting, but I can't get out. So that's why I have to present from where I am. So I really apologize for that. And I hope we'll be able to communicate. Thank you very much.
So we've got the presentation online. I think could we make it, can you see the presentation, Mr. Mukaru, or?
Yes, I can.
Okay.
Thank you very much for that. You want me to start right now?
Yeah, please do. And, we can just, yeah, thank you. So we have about 15 minutes. We can go through the other stuff a bit faster and focus on the housing innovation. But please do start.
That's very well. Let me start by just briefly talking about Caritas Microfinance Bank. As you can see on the first screen, it's the people of God, and it's how the bank started and where we are now. Started between 1971, 1997, when the first servant of God deposits and number of clients have enabled us to really scale up in terms of growing our loan book. And it has been a journey and a significant experience we can be able to share in other forums. Profitability has also been reasonably good compared to the sector. Over the past 5 years, we were loss-making because of the establishment, the expensive. But the last 5 years, we've seen significant growth, and we thank God for it. So there is a mixed growth, but very, very consistent, and we now can be able to say that we can be able to move on as an institution. Let me say that we one of the only 4 microfinance banks making profit in Kenya. We are the fastest growing microfinance bank in Kenya, and it has not been easy when you consider the microfinance bank environment. Over 10 of them are making losses, so it's been a challenge, really going against the grain to be able to establish an institution like this for the benefit of the people. The issue of housing has been very close to us. We started what we call rent milele. Rent milele was targeting households that had a piece of land, but they needed to develop that piece of land on their own, and also now start an income-generating activity by developing other housing structures for rent or income. But when you look at the state of housing in Kenya, which I'm very sure we've spoken about, and we have seen, home ownership in Kenya is considered as one of the basic and very emotional asset acquisition. That we've seen. The Kenya housing sector has significant deficits. When you look at the urban and the peri-urban and the rural areas, significant differences. People in the rural areas own their homes, but when you come to the urban area, you find that home ownership reduces. When again you look at the issue of challenges of affordability, waste management, water, sanitation issues, you find that there are more people paying rent in the urban areas than in the rural areas. And these are significant issues that have also contributed to our coming up with this product we are calling rent. So our Caritas approach, which is rent targeted homes, targeted households that needed to invest in themselves and also needed to invest in rental properties. And we came up with a loan product that was between 500,000 and 20 million. And the basic approach on this is that households started developing their homes from an incremental, what you call tranche approach. They start by putting up a small structure for themselves as a household, and then gradually and continuously grow into a rental. So it is an incremental approach. And incremental approach because mortgage to them is a foreign. They find mortgage to be a little bit expensive because you get so much money at the front, whereas you do not have consistent income. So it's been a discussion. Do they have collateral to be able to get a lot of money at the same time? That has been a significant challenge. So our loan support has been to the families. The loan tenure is about 60 months. The interest rates are usually risk-based. I know we say it's between 24 and 30, but based on the current market approach, it is risk-based, and we look at quite a number of issues. But we cap at the household level, we cap the monthly installments to 60% of the regular income. So that now the household can be able to have 40% to be able to improve their families. So we are able to finance both the house itself and other additional benefits to their homes. In terms of in terms of deposits that have accrued as a result of households that are accessing our rental loan. And they also accumulated investments where they even brought in term deposits for them to really be able to benefit from our rental loan facility. So what we see is the cost of funds have over the period reduced significantly, and these benefits have been transferred to our households, where they are able to benefit on lower interest rates facilities under the rental loan. So seeing good growing deposit base experience, and this has translated to what we are now talking about, the benefit to the household. What are the factors limiting scale and in this housing segment? What have we seen? Lack of collateral on the demand side, the poor credit history. We've seen that information required for us to make a decision. Definitely, the high cost of credit has also deterred our families from accessing loans. Lack of adequate documentation. Majority of the areas we go to, they do not have formal securities or formal documents. It's a family land. The 5 or 6 people are sitting on it from the same family, but they do not have formal titles. So again, income is an issue, low income, and also inconsistent income, because majority are in the informal sector. And of course, again, the other challenge of high cost of building material, like I think has been mentioned, low financial literacy, and awareness of what is required to put up formal structure, like the BOQ requirements, formal application through the municipal councils and through the government. It's been a significant challenge around there. Again, on the supply side, our households are requiring long-term funding, which based on our deposits, we do not have long-term deposits. And that's that level as we move on. Again, on our side, we have operational costs, definitely regulatory and policy barriers, where families are told they cannot occupy a house which is under construction, and yet we are encouraging them to use an incremental approach. Of course, on our side again, information asymmetry has been a significant issue that over the period we deal with that. These are the type of families we are dealing with on the ground. When we look at the picture on the left, it is the owner who has put together that iron sheet house, and over the period they required now to put up on the empty piece of land which is in front of the iron sheet house. For the period now, we assisted them to put up the stone walled houses. Slowly by slowly, they were borrowing loan amount of 500,000 over a period of time, and they came back and they continuously applied themselves until they are able to complete those houses. When you look at a single tranche of about 500,000, it attracts about 28,000 monthly installments. But when you look at the projected rate of income is about 100,000 with about 5 units. So the client is able to repay the loan using the rental income that has been received by the family. So that is the approach we use, and you can see again the next picture is same, where the rooms were different, they applied themselves differently, and then we assisted them to do much better. And over the period now, you can see the kind of houses that our families are able to put up.
If I could interject, Mr. Mukaru, sorry. On the third case study, I think this is an interesting example of where the landlord is blending finance. he's got income from another building that's allowing him to get such a big loan. So, and we're also being prompted to be a bit faster, so I'm just, requesting, Please go ahead.
Thank you very much. These are clients who require a little bit bigger loan, but using the same approach. Initially, their houses were the way they are on the left, and then they upgraded themselves. But these are now clients who have got a bigger capacity to borrow. Most of the land they are sitting on is documented, so we are also able to grow them in that kind of manner. So we've been able to do this for quite a period of time. When you look at the loans we provided on the ground, all the way 5 million loans, a million loan, we've done some simulation. Are they able to benefit? Yes, based on the return on investment and the tenure of the loan, they're able to benefit, and the family is able to transform themselves. So we see quite a good future for these facilities, and Caritas has a significant potential to expand the scale to both the low and middle income households through what we are calling incremental housing and micro housing models. For us to be able to do that is to acquire capital, is to have strategic partnership, and to also ensure that we have other options, particularly in terms of value chain, be able to provide other additionalities in terms of solarization of our family areas, and be able to really start benefiting from what we are calling carbon credit funding vision for housing. So it's important for us to really be able to look at other options that can be able to de-risk and can also be able to reduce the cost of funds for our clients. So that's why we are talking about carbon credit funding vision for housing. This way we are able to bring the risk return by bringing in the carbon finance in these micro housing loans. It will reduce the high operational cost, and the high carbon financing can be used to de-risk the whole of these value chain. So thank you very much. And basically that's what I can be able to say what Caritas is doing. Thank you.
Thank you, Mr. Mukaru. It's amazing the technology works so well. I'm begging for requesting for 5 minutes to run through a few points that we've thought about. So first, when we talk about microfinance and the high cost of interest, I'd like to draw attention to the simple calculation. If a family borrows 5 million in one go, please could we have the biggest slide up? Mr. Mukaru, please wait. At 12%, their total interest they'll pay over 120 months is 3.6 million. If the same family borrows 1 million 5 times, consequentially, the total at 24%, so double the interest, the total interest over the loan cycles is 2.4 million. I think it was Simon Wally who made me think about this. So I just want to make this point that it's really, when we talk about high interest rates, we've got to put it in context of the tenor and the very small loan sizes and the high operational costs. So it's not, we need to put that context. And then something I feel I just must take 2 minutes to talk about is all the open access resources that we've been developing with CAF. This is an example of a 1/4 acre piece of land. We've thought through the land cost, infrastructure cost, construction approval, and we've created the whole Excel model as well. So the challenge and the call to action I'm putting to all the stakeholders who've come here and invested their time is, can we find a way to bridge between what Liaison Group with all their partners have enabled with the 4 billion shilling fund and what Caritas does with 500,000 shillings to the borrowers, and try to come together to create a few pilots where we're doing ground plus 4 housing and really learning the delivery realities, the costs, and who lives there, and helping to get the people who live there be credit rated. We may need short-term concessional construction finance, but I do feel these can be removed with time, with both economies of scale, trying to unlock VAT incentives, and just repetition. So this is my call to appeal. I hope when we're meeting next year, there's some progress towards something like this. And we've talked about the very, very high cost in the convergence thing. There are talks about pre-feasibility. We've put this out there. It's all on the website. The different design typologies, architectural plans, structural plans, and BQ. So they're not going to replace your feasibility, but at least they can help you know whether it's a go, no-go without spending too much time and money. We looked at that in a Ground Plus 4, and we also looked at that in a very interesting model in informal settlements where they do ground and then 2 stories above. The plans are online. The people in the room from CAF, Muthoni, Beatrice, everyone helped with this, Alan. And what we're trying to say is if we could enable a construction and offtake finance, what I loved about Linzi Sukuk was they were not doing construction only and offtake only. The two are not going to meet in our nascent markets. There's always going to be problems with making that bridge happen at the time it needs to happen, and then the project goes in distress. So if we can find a way to do a 10-year, simply a 10-year financing structure, if you can build Ground Plus 2, the cost of these units are 1.1 million because so many cooperatives have land. We can take you to hundreds of acres where they have land. And then the repayment goes down because you can collect the rent from the first and second floors and the family can stay in the lower floor. And we can see the saving and affordability if we can just enable that. So with that, I don't think we have time for questions, or are we allowed a burning question to both the presenters? Okay, one to Victor, please, and one to Mr. Mukaru, and thank you.
Seeta, I'm not sure we have a question.
That's okay, then I guess we're staying. But really want to thank both the presenters, and we hope we can do a lot more of the Linzi Sukuk, bring it a bit down market. Thank you very much to both my panelists. They've really worked hard. Thank you.
Thank you.